Welcome to Trader TV Fixed Income, your insight into the trading climate for professional bonds investors. I'm Dan Barnes. Within traditional fund managers, the trading desk is the point at which investment strategies are made real. Returns are realised, or not, as those strategies play out against market events. For hedge funds, returns can be generated through trading itself, as opportunities present themselves. In June's show, we'll be talking about alpha generation with Sean George, Chief Investment Officer at hedge fund Strukturinvest Fondkommission, and digging into the different ways a hedge fund manager trades. Market data is provided by NTS. Sean, welcome to Trader TV.
Thank you for having me.
So, could you tell us a little bit about the fund that you manage, or funds that you manage, and the way that trading execution differs for you than it might for a long-only asset manager?
I'm the Chief Investment Officer for a fund called Hamiltonian GCO. It's a global credit fund. I launched with about $50 million.
You have more flexibility than a traditional long-only fund manager might when looking at the investment and trading process combined, don't you? Could you explain how that flexibility is sort of manifested?
Well, so to begin with, we are an AIF, so an alternative investment fund.
Yep.
And then you have a UCITS fund, which is the format for traditional long-only funds.
Yes.
We looked at the UCITS format and we looked at the AIF format, and we chose the AIF format. And why we did that was just exactly for that, the flexibility, the levers. We can short bonds, which you can't do in a traditional UCITS fund. And
that's short selling, so...
Yeah, short selling, so that we are betting on the price, or we're investing in a bond that we think the price is going to fall.
Yes.
And for example, the people that did that in Italy had great months in May. The people that were long Italy had terrible months in May.
Yeah.
So you can be risk mitigating. You can use more leverage. So for example, if I wanted to short Italy,
yes,
which we didn't, so I'm not saying that we did, but I wanted to short Italy on the way down.
Yes.
And then we felt that on that Tuesday, when we had the big event in the 2-year, that this was overdone. The market is pricing a binary event, i.e. that Italy is going to leave soon, which we didn't believe. We can also deploy leverage. So in our fund, we use a nominal amount of leverage. We can use up to 3 times net leverage, which is not a lot for a hedge fund. A UCITS fund, I think, can do about 1 times net leverage through derivatives.
Yes.
So we deviate from the UCITS fund, but now as the market's kicking up, as it's coming back from the lows, deploying that leverage provides a greater return.
Yes.
So I would say that we have a break in that we can hedge via shorting bonds and buying derivatives. And we have a turbo, whereas we can use the leverage coming out. If you imagine you're coming into a turn on a racetrack, you want to have some brakes going into that corner, and then you want to have the turbo coming out. And that's the difference of flexibility you get in a AIF versus a UCITS.
Do the portfolio manager and the trading function, do they interact in a different way at a hedge fund compared to a long-only fund, do you think?
We're an emerging hedge fund manager, so the PMs and traders are the one and the same. So Ulf Erlandsson and I, we're the PM, the trader, and the analyst at this stage. In our instance, we think the trader-PM function works. When I started out on the buy side in 2000, the trader was the PM as well.
Yes.
That was a long-only insurance company that had total rate of return assets as well. So from where I come from, I like the trader and the PM to be the same person. I know it's very popular to segregate the trader and the PM role, but I think there's information slippage. So what I may view as important may not come to me from the trader. And remember, the corporate bond market is still very voice dominated, i.e. a lot of the transactions that we conduct are done by phone. When you're on the phone with somebody, and they know you, trust you, or you've known them for 2 decades, and as in my case, you're going to get a little bit more information, you're going to get the extra bit of color, and if the trader and the PM is the same person, all that information gets synthesized into the organization and processed properly.
That means you can react quickly to things, presumably, which might be more challenging if that function's separated.
I mean, a perfect example was Italy a couple of weeks ago.
Yes.
We were stunned because we were in the middle of ramping when this started to percolate, and We stopped buying, so we had only invested a little bit of our funds, and everything that we bought was down during that period. I don't think there was a lot of people that had any assets that were up during that period.
No, quite.
But when we looked at each other, we read, some articles in the Constitution. It wasn't as simple as the market was pricing. They're leaving now.
Yeah.
And then we turned to each other and said, I think this is way overdone. Mm-hmm. And then we said, okay, where are the best risk-adjusted opportunities for us? So we can buy dollar, sterling, krona. And we looked at the Euro AT1 bank market, so the contingent capital bonds that the banks have issued. And we were looking at bonds that were down 8-9 points in a very short period of time. In a 3-4 week span, they had spiked down.
Yeah.
We turned to each other. We said, okay, we are comfortable with a tiny bit of Spain, a tiny bit of France, and very comfortable with Scandinavia, very comfortable with the UK. And we ramped up our book on that day. Today, we obviously had the ECB discussions, or the information coming out about the bond purchases.
Yes.
And 2 days ago, DTCC, so this is where all the derivatives are deposited, and when everybody can see the numbers, which is a positive, to show that the market had over-hedged going into this decision. Oh. And so the net positions were very, very short, the European market through Main and iTraxx. Well, they hedged a fixed rate problem. So the problem was that the underlying treasuries, the risk-free rate would be rising, and they would stop buying corporates. Well, if the risk-free rate rises, and we have those two indices at the same level they were before the ECB started buying, it made a very easy decision for us. We're supposed to be long going into this, and we set a long at wider levels than they were even this morning. And that information, that decision-making process, when I turn to Ulf, Ulf turns to me, synthesizes directly into the portfolio, after we've done all of our homework and dotted our I's and crossed our T's.
That's a great example, thank you. And so the flow of data and the information that you need, presumably you need a wider range of data than a portfolio manager might if they had a more limited set of choices.
Exactly, and that's a fantastic question. Luckily, my partner, Ulf, is a quant.
Yes.
And he has several models that will alert us to moves that are bigger in the market than normal market moves.
Yep.
And we can go and SWAT team, if you will, to be an American, the situation. Is it AT1s in Europe like it was these past couple of weeks? Is it Spanish covered bonds? Is it U.S. high yield? Is it U.S. investment grade? Is it the TMT space in the U.S. because of all the M&A? Whatever it may be, it's almost like a fishing line. So like it will pop up like, oh, there might be something on the line, and you reel it in. It's seaweed, or reel it in, and I got a big fish, and then we'll decide, okay, this looks like an interesting position to have in the portfolio, and then we'll do the fundamental analysis after the fact. Two people cannot cover as much ground as we need to cover, but with the quant analysis that we do, we can cover that ground and then only focus on the things that actually have moved where we think there may be an opportunity.
So what sort of scale limits are there to a hedge fund strategy?
So we have sized our fund based on the restrictions that we have around it. We've capped it at $500 million, which is rather low for a credit hedge fund.
Sure.
But we did that for two reasons. One, we have a daily NAV and daily liquidity. But secondly, our transaction costs, we can use 3 times leverage, our transaction costs become onerous, i.e. it pulls away from the performance of the fund if I'm too large. So we set a cap on our fund to protect against the transaction costs.
Sean, thanks very much for coming on the show.
Thank you, it was a pleasure being here.
I'd like to thank Sean George for his insights today, NTS for our rates data, and you for watching. To catch our monthly reports on the market or to subscribe to our newsletter, go to tradertv.net.